So we're going to do some practice now in distinguishing between revenue and collections and expenses and payments, and understanding how that creates reconciling items in the indirect method of presenting operating cash. Let's look at the salary payable account. What if the balance dropped by $20,000? So the beginning was 30 and it went down to 10. That's a drop of 20,000. Which was bigger, payments or expense? Payments had to be bigger by the 20,000 in order to get the balance to drop. That drop in accounts payable meant that what came out of net income wasn't as big as what came out of the checking account. So you would have to subtract that 20,000 from net income to get down to operating cash flow. What if they told you the salary payable amount decreased and they told you expense was 40,000? Then you could solve for the amount of the payments. Of course, this would still result in a $20,000 reconciling item to reduce net income to get down to cash flow. Why? Because net income was reduced by the 40, but the bank account was reduced by the 60. So to go from the 40, which is already in net income, down to the 60, which is what came out of the bank, you'd have to minus another 20. Let's try another. What about the income taxes payable account? What if it went down by 30,000 during the period? Which were bigger, payments or expense? So the beginning to the end, there's a drop. In order to do that, the payments to the taxing authorities had to be bigger than the accrual for taxes owed. Let's try another. What if the income tax payable account went up by 30,000 and they tell you that the payments were 40,000? So you pop the payments in there and you know that the balance went up. The only way for the balance to go up is to have accrued in 30,000 more than what you paid. Then whatever this is, it would be 30,000 higher at the end. So what would the reconciling item be here? What went into net income was reduced by the 70, but the bank account was only reduced by the 40. So you would add that $30,000 reconciling item back in. So net income would be increased to get to operating cash flow. Let's try another. What if the accounts receivable balance grows by 70,000? So if it was 10, it grew to 80. That's a growth of 70. Which was bigger, collections or revenue? Revenue has to be bigger to get the account to grow. Whatever collections were, the debit to billings had to be bigger by 70,000 or accounts receivable would not have grown. That 70,000 increase is going to be a reconciling item in the cash flow statement. What if they did tell you how much billings were? Then, without knowing the beginning or ending balance, you could still solve for this because the collections would be 70,000 less than the billings. That's the only way you could get accounts receivable to grow from beginning to end. So the reconciling item would be 70,000 and you would be subtracting it because net income went up by the 440, but the bank account only went up by the 370. So going from net income down to what was collected, you'd have to subtract out the 70. Let's try another. Let's try the prepaid account. What if the prepaid account grew by 30,000? So for instance, what if it started with 2 and ended at 32? Which was bigger, the payments or the expense? Payments make prepaid go up, expense makes prepaid go down. So the payments had to have been bigger than the expense. What if the prepaid insurance balance went down by 30,000 and they tell us the expense was 40,000? So what expired and was charged to insurance expense was 40,000. The balance from beginning to end dropped by 30,000. The only way that can happen is if there was a payment of 10. So now there would be a reconciling item of 30,000, the difference between the two, because what reduced net income was the 40,000, but what reduced the checking account was the check that you wrote for 10,000. So you would add back $30,000 when you move from net income to operating cash flow. This takes a little while to soak in. There is a little secret to it. Here's my little secret, the mechanics, to be sure that you get the direction right when you're building an indirect cash flow. When assets go up, you subtract that shift from net income to get to operating cash flow. If you can remember this piece, you can get all four pieces. If assets are up, subtract. If assets are down, the opposite, add. So we always look for the opposite. If assets go up, what about if liabilities go up? You do the opposite. What if liabilities go down? You do the opposite. So if you remember the first one, if assets go up, subtract, you can always recreate the opposites.